Hello friends. Now in this part of the discussion we'll be taking up the next chapter, and the chapter is going to be of capital structure. Manageable chapter, because once you have gathered the knowledge of leverages to an extent, that concepts do get applied in capital structure as well. So let's understand capital structure. If comes in the exam, then it would range from 8 to 10 marks. Manageable chapter again. So if you would have realized, we'll be sticking to the same methodology. Our strategy would be the same, to first understand the meaning, the objective and the scope. So let's understand meaning of this chapter. Friends, what do you understand by the word capital? Capital is nothing but money which is required to start or run the business. If you refer the dictionary, you will find the same meaning. Money that is required, funds that are required to start or run the business. So the word capital is money that is required to start or run the business. This is what is the meaning of the term capital. If you refer the dictionary, you would realize that the word structure is actually nothing but arrangement. So the word structure is arrangement. Now, if I coin both these words and if I tell you, put it in simple words, what is going to be the objective of this chapter? What will this chapter teach us? This chapter will teach us how to arrange what? The money that is required to start or run the business. Object is very clear. So the chapter will teach us to give the answer to this question. Which question? How to arrange the money that is needed to start or run the business. Remember friends, it is not going to teach us how much to arrange. It will teach us how to arrange how much is required. So it will help me to give the answer to this question. So if I raise the objective of this question, it will give me the answer this way. How should we arrange? Now when I'm using the word arrange, you can use it as raise. How should we arrange or raise the money required to start or run the business? The answer to this question will be given by this chapter. How should we raise the money that we need to start or run the business? And believe me, answer is also very simple, friends. Answer is what you know. Arrange money, raise money in such a way and in such a manner that it maximizes the wealth of the equity shareholders. So our objective should be what? To maximize wealth of our equity shareholders. Wealth, when will it increase? Wealth increases whenever market price of the equity share increases. So I can say wealth is similar to market price. So whenever market price of your equity share will increase, your wealth will increase. I can give an example. Suppose you have purchased share of this company TCS. Now when you purchased, it was at 2000 rupees. And suppose the market price of the share now reaches to 2500. So we can say your wealth has increased by 500 rupees. Why? Because market price increased. So our objective should be to arrange money in such a way that it maximizes the wealth of equity shareholders. In short, it maximizes the market price of the share. Now, when can market price of the share increase? When do you think, when will MPS increase? One determinant, one factor that maximizes the MPS is EPS. So what does it mean, sir? It means arrange money in such a way that it will maximize your EPS, and if EPS gets maximized, consequently MPS will maximize, and so will be your wealth. So we should arrange money in which way? We should arrange money in such a manner that it maximizes the EPS. So question is, will arrangement of funds, will the pattern of arranging money affect EPS? Of course, yes. So how should we arrange? Arrange it in this way, which will maximize your EPS. So what will be the role of this chapter? The objective of this chapter is it will teach us to select how to decide how should we raise money. That is, you will calculate and compare EPS of all different options, and wherever your EPS is maximum, you will take a call accordingly. So in short, you have to just calculate, compare the EPS. Whichever plan maximizes your EPS, go for that plan. That's it. That's the only thing we have to learn here. So that is one point. So we have discussed the meaning. It's money required to start or run the business. Objective, it will give me the answer to this question. Arrange the money in such a way that it maximizes the EPS. The answer goes this way. Arrange money in such a way that it maximizes MPS. That is the objective. Now MPS increases whenever EPS increases. So our whole focus would be to get the best plan, and the plan which will maximize the EPS, that should be selected. That is one point of the discussion. So this is one scope also. So the scope of the chapter is one, selecting the plan. The second is, once the selection is done, then you have to learn one more concept about something called as indifference level. Indifference level, which can also be termed as indifference point. And the last in the league here is going to be financial break-even point. FBEP, or we can say financial break-even point. This is what is the scope of this part of the chapter, friends. We need to learn these three things. Financial break-even point. Okay, so scope, select the plan, calculate something called as indifference level, financial break-even point, that is nothing but the FBEP. But you keep the stuff at the back of the mind that while selecting the plan, my objective has to be to increase the EPS. That's it. Okay, so we will take up sums and we'll understand all these calculations while solving the sum itself. But definitely this is the basic crux of the entire chapter. So let's take up question number 1, that is based on this chapter of capital structure. I'll be going a bit slow so that we cover up all the concepts of this chapter in that same sum itself. So let's understand now question number 1. Okay, so let's take it question number 1. Now this sum originally was only up to point 1, but we have added 2 things further so that we cover up all the concepts in this sum itself. Now let's read question number 1. Adarsh Limited is considering methods to finance its investment proposal. It is estimated that initially 4 lakh rupees will be needed. Two alternative methods of raising funds are available to the firm. First is issue 15% loan amounting to rupees 2 lakh. Issue 2000 equity shares of rupees 100 each. Issue 4000 equity shares of rupees 100 each. The appropriate rate of tax is 35%. Assuming operating profits, that is EBIT, of rupees 70,000, 80,000, which financing proposal would you recommend and why? Compute the indifference point of the two financial plans and also verify the same. Calculate the financial break-even point. Now, there are three things that are to be answered, and all the concepts I'll be discussing and covering up in the solving of the sums itself. Now, when the question is telling us that which plan would you recommend? When the question is telling you calculate indifference level, when the question says calculate FBP, this itself is a leading indicator that the sum is from the chapter capital structure. And my suggestion to you guys would be that whenever you come to know that it is a sum on capital structure, you prepare one small table, which I name it as financing plan details table. The advantage of that table would be you don't have to refer the question again and again, as entire data will get summarized in the tabular form. So let's understand the financing plan detail table. So you will be preparing this table whenever you have to solve a sum on capital structure. Now first, if you notice in the question, we already know how much of the money is needed. We require 4 lakh rupees. So funds required are 4 lakh. How many options do you have to get this 4 lakh rupees? Check. How many options? It has two alternatives. So I would say that the total money that is required, funds required 2 lakh rupee, I think 4 lakh rupees, and here also it is rupees 4 lakh. And how many options do I have? Two options. On reading the first option, the question says this 4 lakh can be arranged by taking a loan, 15% loan amounting to rupees 2 lakh, and the balance 2 lakh rupees will be raised by way of issuing equity. So we have equity share capital. Whereas here in the next case, if you notice, no loan will be taken, entire 4 lakh will be raised by way of issuing equity shares. That's it, that is one. Second, now once this point is done, then the second point is we need to take into consideration the number of equity shares. So we have number of equity shares. In the first plan, how many shares are we going to issue? If you notice, in the first plan, we are going to issue 2000 equity shares, whereas here we will issue 4000 shares. And the applicable tax rate is going to be 35%. So friends, this is what is my financing plan detail table. It is not mandatory, it is not compulsory to prepare this table, but the moment you prepare it, it will be of great help to us while solving the sums. So let's take up the required part 1. Once this basic structure is ready, we can very well finish off the required parts. So first, question says, assume operating profits, that is EBIT, of 70,000 and 80,000. Which financing plan would you recommend and why? So the question says, let's presume that we earn from our profit 70,000 rupees. If we earn 70,000 rupees, should we select plan 1, that is this pattern of arranging money, or should we go for the second one? How would you determine, friends? What is your viewpoint? How should we go ahead with this thing? We should select the plan between the two which will maximize my EPS. So whichever plan will maximize our EPS, we should go for that plan. Okay, so from where do we get the EPS? Which statement do we need to prepare the EPS? Sir, income statement. Okay, so we'll prepare the income statement, and by preparing the income statement, we'll come to know which plan maximizes our EPS. My next question, have we already raised these funds or we are planning to raise? Sir, planning to raise. So the income statement which I'm going to prepare here, do you think, is it going to be an actual income statement or is it going to be an estimated one? Sir, if these are all plans, so definitely, sir, the income statement has to be an estimated one because that is also a planned income statement. So what we have to do is we just have to prepare plan wise our income statement, and when we prepare the income statement, the one that will maximize our EPS would get selected. So I'll prepare the income statement for you guys. So let's understand this income statement. So my heading to the first required part is estimated income statement. Estimated income statement. Now, the question says you assume that the EBIT could be either 70,000 or it could be 80,000. Which plan would you recommend and the reason for that? So this is like the format of my income statement. So we have particulars, and the question says assume that your EBITs are 70,000. So if I assume that my EBIT level is 70,000, then which plan should I select? Plan 1 or should I go for plan 2? If I assume EBIT of say rupees 80,000, then which plan should I select? Plan 1 or should I select plan 2? That is what we need to answer. And that is possible by preparing an income statement. In the chapter of leverages, we learned an income statement which starts from sales, ends at EBIT for operating leverage, starts from EBIT, ends at EPS to get the financial leverage. Now, since my whole focus is just to compute EPS, if the question gives me information from EBIT onwards, I can definitely go ahead with that information as well. So my income statement in this chapter would begin with EBIT. Now, from the EBIT, friends, can I say we will deduct interest? When we deduct the interest, the resultant becomes the EBT, less the tax gives me EAT, profits after tax. Anywhere in this table, see, I'm telling you that utility of this table. Anywhere in the table, did you find preference capital? No. So we can say whatever is the earnings after tax itself is the profits for our equity shareholders. Then you need to calculate the EPS, so you divide it with the number of equity shares, and that's going to give you the earnings per share. Is that okay, friends? So this is what we need to fill out the table now. So what should be the level of EBIT here? So my EBIT here will be 70,000, and here also it's going to be 70,000. But here in plan 1, 80,000, and here 80,000. Now from the EBIT, I would then subtract the interest. To know interest will appear in which plan, I need to check the table. Now in the table, if you notice, there are two plans, but it's only plan 1. It's only plan 1 you find the loan amount of 2 lakh rupees at 15% rate of interest. So if I calculate the interest, it will be 30,000 rupees, and that's going to be only under plan 1 because there's no interest in plan 2. So here also it's going to be 30,000. and nil. And when you subtract this EBT, interest from the EBIT, you'll get is 40,000. That's going to be the EBT. Here it's going to be 70,000, 50,000 and 80,000. The applicable tax rate also, friends, as I told you, we can get it from our table. So that's going to be 35%. Now, we can compute the tax amount by applying the rate of 35%. So we can say 0.35 into 40,000. So that's going to be 14,000 of tax here. Then we get 24,500, the amount of tax. Then 50,000 will be giving me a tax liability of 17,500, and then 80,000 is 28,000. And when you subtract the tax, it becomes EAT. So we can say this is going to be 0.65 into 40,000. So this is 26,000. Then we have 45,500, 50,000, 32,500. This is profits for my equity shareholders, and 52,000 rupees. Okay, so the number of equity shares, we can again get it from our table. As I told you, that's going to be of great help to us. So this is 2,000, this is 4,000, 2,000 and 4,000. So let's calculate the EPS, friends, and that's going to be 13. Now we can say 45,500 divided by 4,000. That's giving me 11.375. 16.25, and this is also going to give me 13. So these are the respective EPS. What's the required part of this sum? The first one says if you expect 70,000 from your business as profits, if you expect 70,000 rupees, then which plan would you recommend? I would now compare the EPS of the two plans, and on comparing the EPS I can make out that it is plan 1 which should be selected. So our conclusion will be what? If we expect EBIT of 70,000, it's advisable to select plan 1. Similarly, now the question says, what if you expect that you will earn 80,000 rupees from your business? So from your main business activities, if you earn 80,000 rupees, then what is your view? We should select which plan? Again, we would recommend plan 1, as it is maximizing the EPS. That's what's my objective. So conclusion to the first point says, if the expected EBIT is 70,000 and 80,000, it is advisable to select plan 1, as it will maximize our EPS. Is that okay, friends? Fine. So this becomes the answer to the first point. Second, now the second point says compute the indifference point for the two financial plans and also verify the same. Okay, so let's understand this concept now. Compute the indifference point, the indifference level, and also verify whether your indifference level calculated is correct or not. For this part of the discussion, what I would like to do is I would like to erase this calculations which I have just done, keeping EBIT of 70,000 only. I would like to just erase this information so that we can understand the stuff easily. Okay, so the question goes this way. If I tell you select the plan, you would say, sir, we just now gave the answer. We should go for plan 1 because it is maximizing the EPS, sir. I said, okay, great. What do you understand by the word indifference level? Tell me, friends, how would you interpret indifference level? When will your answer be, sir, go for any plan? Think. At present, when my EBIT is 70,000 rupees, can I say we are recommending plan 1? But I want you guys to think about this and tell me, when will your answer be, sir, go for any plan? When will your answer be, go for any plan? Can I say, when both the plans will give us the same EPS, then our conclusion will be go for any plan. Acha, when my EBIT is 70,000, am I getting same EPS? No. So at what level, my objective is, at what level of this EBIT I should get this same EPS? At what level of this EBIT I should get the same EPS? That level of EBIT where I get this same EPS, that level of EBIT will be technically called as indifference level. Are you getting it what I'm telling you, friends? When it was 70,000, our EPS was different. We were selecting plan 1. But now I am telling you, my answer should be go for any plan. So the level of EBIT where my answer comes, sir, we are indifferent, sir, go for any plan, that level of EBIT is technically called as indifference level. So what is indifference level? Indifference level or indifference point between two plans is that special EBIT. The indifference level is also EBIT, but what is the speciality of that? At that level of EBIT, EPS of plan 1 equals EPS of plan 2. That's what's the speciality. So sir, what we are supposed to do here, we have to find out that special EBIT. Once found, that special EBIT is going to be termed as indifference level. So let's learn how do we calculate that indifference level. So I have to erase this part of the information, but I hope you have copied down this part and it should be there in your notebook, because to understand the indifference level, we will again use the same data for our calculation purpose. So in case if you haven't copied down, you can just note it down as soon as possible, this part of the discussion. Okay? Okay. So let's understand computing this indifference level or the indifference point. So I would say this way, our objective is now to calculate indifference level. And this can also be termed as indifference point. Now we have just discussed what's the speciality of this. It is like EBIT only. Just remember, friends, I'm again telling you, this is nothing but a EBIT level, operating profit level, but the speciality is at this level, EPS of both plans is the same. That means I can say at indifference level of EBIT, EPS of plan 1 just equals EPS of plan 2. That's it. This is going to be your indifference level. Now, what EBIT this happens, once you know that, job is done. So how do we calculate that special EBIT? Sir, should we prepare again an income statement and do the calculation? No. We can use a technique which can help us to get the answer. I would like to make an equation to get the EPS, friends. And I'll need your help here, because this point we have discussed somewhere in chapter of leverages as well, where I told you that in leverages what we are going to learn, that concept of pre-tax post-tax will get applied here as well. So let me make an equation for EPS. How did we get this EPS here, friends? If I go by the income statement, it is EBIT less interest gives me EBT less tax, EAT, number of equity shares are divided, and then we get the EPS. So if I now make the same thing in an equation form, how it would look like? See, it goes like this. I start with EBIT. वो साथ में रखना please, थोड़ा दोनों साथ में आना चाहिए. From the EBIT, then I subtract the interest. So EBIT minus the interest. So EBIT minus the interest gives me EBT. So when you subtracted this EBIT interest from the EBIT, we now have EBT. That is nothing but profit before tax. Anything which is before tax, friends, anything which is before tax. how it is converted into post-tax leverage. This is before tax. Anything which is before tax, if you want to convert it into after tax, just multiply it with 1 minus tax rate. So the moment you do this, where have you reached? Can I say we have reached directly to the figure of EAT, that is earnings after tax. From the earnings after tax, if I deduct preference dividend including DDT, then what do I get? What I get is the earnings for my equity shareholders. And if I divide this with the number of equity shares, do you agree, friends? What I'll now get is nothing but earnings per share. So the same thing, what we have drawn an income statement, if I make it by way of equation, this would look like this. EBIT minus interest into 1 minus tax rate. So we are converting pre-tax profit to post-tax by multiplying it with 1 minus tax rate. If there's any preference dividend, we subtract that. The residual profit now is for your equity shareholders, divided with the number of equity shares. It will give you the earnings per share. But my objective is to make EPS of both the plans the same. So we have this to be plan 1. Same equation we will write here as EBIT minus interest into 1 minus tax rate minus the preference dividend including the DDT, the whole divided by number of equity shares of which plan? Of plan 2. Now, if you have understood my explanation, then tell me, in this equation, what are we supposed to find? Think, what are we supposed to find? We have to find that special EBIT where these two matches. So here our unknown variable is going to be EBIT. We need to find that EBIT, friends. So let's find it now. So first, check, you have the financing plan details. I remember that detail table. You already have the table. Just look at the table. You don't have to refer anywhere. Look at the table. From the EBIT, the first thing that I'll subtract is interest. In plan 1, was there any interest amount? Yes, sir. There was a loan of I think 2 lakh rupees at 15% rate of interest. So this 30,000 will get deducted here into 1 minus point. What is the tax rate? Applicable tax rate 35%. Fortunately, there was no preference dividend, so we can ignore this. In the first plan, we had 2,000 equity shares. This should be equal to, again, EBIT. Plan 2 has no debt, and if there is no debt, then there will be no interest. So this is going to be 0 into 1 minus 0.35 minus no preference capital. So that's to be ignored. And this is going to be 4,000 because the number of shares of plan 2 are 4,000. I need to just solve it, and whatever EBIT I now get, that EBIT is going to be technically termed as indifference level. So let's solve it. 2001s are 2002s are. So this is going to be 0.65, and 0.65 into EBIT will give you 0.65 EBIT minus 30,000 into 0.65. Friends, how much is this going to be? Please do the calculations on your own, please. I'll do it on my own. So we have 60,000 into 0.65. So that's giving me 39,000 rupees here. This equals 0.65 EBIT divided by 2. So we can hit this here, 2 here. So that's going to give me 1.3 EBIT minus. So we can now $30,000 into 0.65 here is actually 19,500. You multiply it with 2, that's going to give you 39,000, and that's going to give you 0.65 EBIT. And when you calculate the EBIT level, so this 0.65 will get subtracted. What you're left with is again 0.65. 39,000 divided by 0.65. We now get EBIT of 60,000 rupees. And this EBIT which we calculated is going to be technically termed as indifference level. You can call it indifference level or indifference point. What's the speciality, sir, of this point? At this EBIT level. See, when it was 70,000 in that original part, first one, when the EBIT was 70,000, we selected plan 1. But when you expect that whatever business you are into, from that business, if you expect that you will earn only 60,000 rupees of profits, then which plan would you recommend? Sir, go for any plan, as at that level of EBIT we would be indifferent. But sir, how are you so sure that at this level both the plans will give you the same EPS? That we can actually calculate by preparing a verification table. Fortunately, that has also been told by the question, verify the same. Read the second point, calculate indifference level, and also verify whether it's correct or not. So what I'll now do is, I'll now keep level of EBIT, friends, here as 60,000, and I would actually check whether am I getting the same EPS, and if I'm getting the same EPS, then my calculations done are definitely correct. So I'll keep EBIT of 60,000 under plan 1. I'll keep 60,000 of plan 2. And now again, refer your table that you have prepared, financing plan details. That can be the savior for us. You can get all the details from that. I did not go through the question paper again, and you know, you have the table, you can check it. Plan 1, you will have the interest, if I'm not wrong, of 30,000 rupees. There's no interest here, so we get EBT of 30,000, and that's going to be 60,000 here. The applicable tax rate is 35%, so 30,000 into 35% is going to give me 10,500. That gets doubled here to 21,000. So I think this will give you 19,500, and that's going to give you 39,000. The number of equity shares, you can check it from the table. That's going to be 2,000, and we have here 4,000. So when I calculate the EPS, friends, 19,500 divided by 2,000, it's giving me 9.75, and the same would come here, 9.75. So if you notice, we are getting the same EPS, and so if I now ask you which plan would you recommend, plan 1 or plan 2, you will simply say, sir, we are indifferent. Why? Because we are getting the same EPS. So what does it mean? What is the indifference level now? Now this 60,000 is giving me the same EPS. So this 60,000 is going to be technically called as indifference level. Are you following what I'm saying? So if I summarize my discussion about indifference level or indifference point or indifference point between two plans. So you need to remember, you can be indifferent between two plans. Is that special EBIT? Is that special EBIT where we are indifferent? That is, at that level of EBIT, EPS of plan 1 equals EPS of plan 2, and that is calculated in the following manner. In exam, if they ask you calculate indifference level, this is the way in which you will calculate. And if they tell you verify the result, then only you verify, else there's no need to verify the result. Is it okay? So speciality of this indifference level is what? If at this level, if I ask you to select the plan, go for any plan. ठीक है? Fine. So that gives me the answer to the second point. So first point was, on the basis of that EBIT which the question had given me, we were asked to select the plan. So that was done. Second one told us to get that level of EBIT where we become indifferent. So we found that. The third and the last point of this discussion is the financial break-even point. Then I'll tell you exactly what both these two, indifference level and FBP, signify. How can we use that? First, let me explain financial break-even point. Friends, what do you understand by the word break-even? Sir, break-even means no profit, no loss. Okay, no profit, no loss to whom? Sir, we are doing the entire discussion from equity shareholders point of view. So definitely, sir, no gain, no loss to equity shareholders. So sir, what is FBP in that? Financial break-even point. understand, I will define first for you guys what is financial break-even point. Financial break-even point is also a special EBIT. The way indifference level is a special EBIT, even FBP is a special EBIT. It is that minimum profits, it is that minimum EBIT which your business should compulsorily generate, else your equity shareholders will be at a loss. So what is financial break-even point? Financial break-even point is that minimum EBIT, minimum profit. इतना तो कमाना ही पड़ेगा. Anything less than this, equity shareholders will be at a loss. Minimum इतना तो कमाना ही पड़ेगा. So else equity shareholders will be at a loss. So break even would be no profit, no loss to whom? To the equity shareholders. That means my objective here will be to have earnings of how much? 0. Because if you have 0 earnings, then we would say that we are at no gain, no loss. And we need to find out that level where the equity shareholders are at no gain, no loss. Okay, so my objective is to get this as 0. To get this as 0. Earnings. So when you divide something, you divide 0 by something, your EPS has to be 0. So at what level of EBIT I should break even? Minimum itna kamana padega. So how will you get that? Sir, we can do this calculation by going reverse. Let's see. Achha, when can your answer here be 0? Obviously, if the profits from your business are 0, then your tax will be 0. So this will also be 0. In plan 1, look at the table. In plan 1, any interest commitment? No, sir. So this is any which way 0. That means this is also 0. Which signifies what? If I have selected plan 1, I think in plan 1, if I'm not wrong, we had 30,000 of interest. Sorry. It was 30,000. Correct? That means if I select plan 1, then I have to ensure, if I have to select plan 1, then I have to ensure from my business I earn at least 30,000 rupees from my main business activity. So if my business is manufacturing and selling biscuits, and from that biscuit business, if I have to earn to meet so that my equity shares are at no gain, no loss, I should ensure that I earn 30,000 rupees. Anything less than that, my equity shareholders will be at a loss. Why? Because this is a pattern of arranging the money, which is making me, I have to ensure to earn that much minimum profits. But if I go with the second case, friends, if you notice, when can I get this answer as 0? When my EBT is 0, I don't have to pay tax. If I don't have to pay tax, this will also be 0. In plan 2, if I'm not mistaken, there is no interest commitment. It means if you have selected plan 2, then even if you earn 0 profits from your business, still equity shareholders will neither be at a gain nor at a loss. So what is break even? No gain, no loss. And understand, financial, if I now ask you a question this way, if we select plan 1, how much minimum I should earn? 30,000. Because if I earn less than 30,000, it will bring loss to my equity shareholders. I don't want that. In case of plan 2, if we select plan 2, then what is the cutoff for us? How much minimum I should earn? 0. Because even if you earn 0 profit, your equity shareholders will be at no gain, no loss. Did you get this, friends? Okay. So I'll summarize my FBP. Financial break-even point is that minimum EBIT which a particular plan should mandatorily, compulsorily generate, else equity shareholders will be at a loss. Whereas indifference level is between 2 plans, every plan will have its own cutoff. Itna to kamana padega. So that itna to kamana padega will be FBEP. Are you getting it? So sir, whenever we have to calculate FBEP, are we supposed to do reverse working like this, keeping EPS as 0 and then keeping EPS as, are we supposed to do this? No, not at all. We can develop a formula for calculating financial break-even point. Understand this now. So the third point of discussion is the financial break-even point. Let us develop the formula to calculate that FBEP, and you will realize it's very easy to do that calculation. So what is the speciality of FBEP? At FBEP, EPS equals 0. If you notice, at FBEP your EPS will be 0. Now what is the formula for EPS? We learned that EPS is calculated as EBIT minus interest. That shortcut which I just told you, that is a statement. You prepare it in equation form, you get the answer. EBIT minus interest into 1 minus tax rate minus the preference dividend including DDT by number of equity shares. This answer you want to be 0. You want this to be 0. So let's solve it. And what is the objective here? In this equation, what are we supposed to find? That EBIT where I get this answer 0. So what I like to do is, this EBIT, I'll keep it onto the left hand side and I'll bring everything onto the right hand side. That EBIT once calculated will be technically termed as FBEP. Okay? Okay, so let's understand now. So this is EBIT minus interest into 1 minus tax rate minus the preference dividend including DDT is, when I multiply the number of equity shares with 0, my answer will be 0. Okay, now I'll take preference dividend onto that side. So we say EBIT minus interest into 1 minus tax rate equals preference dividend including DDT. Now this 1 minus tax rate is being multiplied here. So if you take it on the right hand side, you will divide it. So we say EBIT minus the interest is equal to preference dividend including the DDT by 1 minus the tax rate. Now we take interest onto that side, so we get EBIT equals interest plus the preference dividend including DDT by 1 minus tax rate. Are you getting it? Now this EBIT calculated will be technically termed as FBEP, the financial break-even point. And if I apply this in the sums required part, there are two plans. So if I calculate it for plan 1, in plan 1 we had fixed commitment of interest of 30,000, but there was no preference dividend. So its break-even point is 30,000 rupees. If you go for plan 2, then you have to earn 0 interest plus 0 preference dividend. This is 0. So same answer you can get it. So for exams perspective, this is what is the formula that is relevant, and your formula will be interest plus preference dividend including DDT by 1 minus tax rate. Is it okay? So this is the formula for FBEP. Financial break-even point is that minimum profit which I should earn, so that my equity shareholders are at no gain, no loss. So if I summarize the entire question, I can say this way. First point was asking me to select the plan if we expect 70,000 profits from our business or 80,000. So we suggested go for plan 1 because that's maximizing the EPS. Second point was calculate the indifference level. The indifference level or indifference point between the two plans, and that is calculated by again equating the EPS. So we calculated that EBIT minus interest into 1 minus tax rate minus the preference divided by number of equity shares of plan 1 should be equal to the same formula but divided by number of equity shares of plan 2. In that equation, the variable that is to be found is EBIT. Once found, that EBIT is technically called as indifference level. The third thing was the financial break-even point, which is nothing but the minimum amount of profit which we should mandatorily earn if we select the plan. So if you select plan 1, then you have to ensure that you earn 30,000. If you go for plan 2, then 0. And this means this is like when can your answer of FBP, friends, come 0? Just think when can your answer come 0? When there is no interest, when there is no preference dividend. So when there is no interest and when no preference dividend, can I say there is no fixed commitment? And if there is no fixed commitment, there is no financial risk. So even FBP is a measure of financial risk. The way we have FL as a measure of financial risk, this is also a measure of financial risk. And higher FBP indicates greater financial risk. Jitna commitment zyada, utna risk zyada. Is it okay? So this was your entire question number 1. Maximum 3 types of sums can come in the exam out of this syllabus of chapter capital structure. Select the plan, compute the indifference level, the indifference point, and the financial break-even point. Is that okay? Fine. So once this is done, then we can move ahead with the second one, question number 2. Okay, so we are done with the question number 1. So as such, the point is discussed, but if I want to do some further discussion out of that topic, we can very well do that. So friends, if you notice in that sum, we calculated indifference level, and the indifference level was, I think, rupees 60,000. Financial break-even point, when I calculated for plan 1, that was rupees 30,000, and for plan 2, I think that came to be 0. So what is the significance of this? If you notice, at this level of EBIT, EPS of plan 1 equated to EPS of plan 2, and if I am not wrong, that value was coming to 9.75. This we got it from the second point of the question. Indifference level EPS was 9.75. At FBP, plan FBP for plan 1 is 30,000. It means at this level of EBIT, my EPS will be 0, and at this level my EPS will be 0. So what is the significance of these two levels of EBITs? Let's understand the same with the help of a graph. So we'll get to know what exactly these things explain us. If you notice, if I prepare the stuff in the form of a graph, which can also be termed as our EBIT EPS analysis. EBIT EPS analysis. Now we make our x-axis to be the level of EBIT, and we make this the level of EPS. Let me first start with plan 2, and let me take up the FBP of plan 2. Now friends, if you notice, FBP, again I'm telling you, this is also a special EBIT, and at that EBIT EPS is 0. So if I begin with plan 2, at 0 level of EBIT, I can say at 0 level of EBIT, plan 2 will give us 0 EPS. So this becomes what? This is FBEP of which plan? Of plan 2. Now from the leverage chapter, we made out that when the between EPS and EBIT, it is EPS which is dependent on this EBIT. As we increase the level of EBIT, EPS will naturally increase. Now what is the level of FBP for plan 2? For plan 2, I can say this is the level of FBP, which means if we select plan 2, then if we earn 30,000 rupees, then our EPS will be 0. So this becomes FBP of which plan? Of plan 2. Now, if you look at the third level, that is the indifference level. Now that is again a level of EBIT only, so that is 60,000. The speciality of this level is what? At this level, both the plans will give me the same EPS. So if I actually, draw a line for different levels of EPS, if I draw the lines which gives me the different profitability figure. Again, if I draw this line, so this point where both the plans will actually intersect, this point where both the plans intersect, this plan becomes the point of indifference. So this is indifference point or indifference level. And if you notice, at this level, what will be our EPS? The level of EPS here will be 9.75. So if I summarize my discussion out of the first point, you would realize that at this level of EBIT, that is at 60,000, go for any plan. If you expect that from your business you will earn less profits, then you would realize that it is plan 2. This is my plan 2. This is our plan 2. And this is our plan 1. So if you now check below this, it is plan 2 which is better over a plan 1. It is giving me a higher EPS as compared to plan 2. But if you now check up to this level, plan 1 is not getting dominated by plan 2. But once you cross this level, plan 2, rather I would say plan 1 starts dominating plan 2. So the significance is what you know. Up to this level, a company which has no financial risk, that plan is better as compared to the other plan where risk is more. Once we cross this level, the plan where risk is more becomes more beneficial to the company as it will maximize the EPS. Why this is happening? If you remember question number 2 of leverages, which we discussed in the chapter of leverages, debt brings advantage to the organization provided its ROCE is greater than the rate of interest. Now up to this level, this debt which is there in plan 1 is unfavorable. Financial leverage here is unfavorable. So it would not be appropriate for an organization to raise money by way of debt if it expects that its profits from the business will be less than 60,000. But if you expect that your profits will increase beyond 60,000, the same debt which was unfavorable will start becoming favorable for the organization as it will increase the profits for its equity shareholders. So in that circumstance, we should definitely go for plan 1 as it will maximize the EPS. So that is what you notice in the sum as well. When my EBIT was 70,000, first point of the question, when EBIT was 70,000, I would give a ranking 1 to plan 1 because that is maximizing my EPS. If it was 80,000, plan 1 was getting selected. But you believe me, if you take any level of EBIT less than 60,000, plan 2 will always be better than plan 1. It means I can conclude both indifference level and FBP also help us in selecting the plan. If you expect that your profits from business would be greater than this indifference level, select the plan where risk is more. If you expect that the profits from the business are going to be less than this indifference level, select the plan where risk is less because that will maximize the EPS. So same conclusions we can draw which we have learned in the chapter of leverages by computing the indifference level and FBP as well. So that was just for your knowledge purpose that we discussed. Now keep all the stuff that we have discussed in mind. Let me take up the next sum, that's going to be question number 3. So let's understand question number 3 and we can finish off that sum. Thereafter I've taken sums which are unique in its own aspect, so any point that is going to crop up in the exam you should be able to tackle them. Okay, so let's take up question number 3. Okay, so let's read question 3. Ganpati Limited is considering 3 financing plans. The key information is as follows. Total investment to be raised 2 lakh rupees. Plans of financing proportion. There are 3 plans here, friends. Plan A, B and C. Plan A is full equity, there's no debt, no preference shares. Plan B is 50% equity, 50% debt and no preference shares, whereas Plan C, you realize that there's 50% equity, no debt and 50% preference shares. The cost of debt is 8%. Now what do you understand by this cost of debt? This cost of debt is actually nothing but the rate of interest. Cost of preference shares is also 8%. It means this is nothing but rate of dividend. The applicable tax rate is 50%. Equity shares of face value of rupees 10 each will be issued at a premium of rupees 20 per share. So you can just underline that statement that a share of 10 will not be issued at 10, it will be issued at a premium of 10 rupees. It means what will be the issue price of one share? 20. That is, against one share we will be getting 20 rupees. The question then says that the expected EBIT is rupees 80,000 and you are required to determine for each plan its EPS, the financial break-even point, indicate if any plans dominate and compute the EBIT range among the plans for this indifference. Now, I would like to finish off the first, the second as well as the third one, but in third one I'll not do the entire stuff. I'll only do that part of the job which I feel is important, where you might get stuck. So first says calculate the EPS, FBEP and indifference level. Friends, can I say the moment the question says calculate EPS, compute FBEP and indifference level, all that stuff, we realize that this is going to be a sum from the chapter of capital structure. As I told you and will continue to tell, that when you get a sum on capital structure, prepare a financing plan details table. So let's get ready with the financing plan detail table. So let's understand this. So in this case, could you please check and tell me there are how many plans? 3 plans. And what is the funding required? Just check how much money do we require. So they have named it plan A, plan B and plan C. If you check, you will realize that the amount of funds required, total investment required, if I'm not wrong, is rupees 2 lakh. So whether it is plan A or B or C, you require 2 lakh rupees. Now how are we going to arrange this money here, friends? In plan A, it's full equity. So entire money is going to be raised by way of issuing equity shares. So we have equity share capital, full 2 lakh rupees. Whereas in this plan, there's going to be no debt or no preference shares. Plan B, if you notice, is 50% equity. It means out of this 2 lakh, 1 lakh I will raise by way of equity, the balance 1 lakh I'll raise by way of borrowings. And when I borrow money, I'll be charged interest at 8%. In the third plan, again we have 1 lakh rupees. But this time in this third plan, no debt, 1 lakh we will be raising by issuing preference shares, and that's going to be at again 8% rate of dividend. So if you notice, this is the first thing that I told you to write down. The second thing that you should always check for is the number of equity shares. Number of equity shares. Achha, this time you think in the last sum that we did, the number of equity shares were already given by the question. I think 2000 and 4000. But here that information is not given. So how should we proceed? How should we go ahead with this thing? So if number of equity shares are not given, then we need to check, okay, how do we calculate? Some other information will always be readily available. The question says 1 share can be issued at a premium of rupees 10. It means if I want 2 lakh rupees and if one share is going to fetch me 20 rupees, how many shares do I need to issue? Obviously 10,000. So how did you get this 10,000? Can I say we have taken equity share capital, that is the amount that we need, and we have divided it with issue price. The issue price here given is already 10 rupees premium. So face value 10 issued at a premium of 10, making a total of 20 rupees. What if, friends, if the company was an existing company and this existing company has already some shares which are traded in the market? So if a company is an existing company whose shares are already traded in the market, if question is silent about the issue price, then we are safe to assume that the new equity share will be issued at the prevailing market price of the existing share. Understand, I will again repeat. If a company is an existing company, already has shares that are traded in the market, and the market price of the share given is say 100 rupees, and company is planning to go for a fresh issue and the issue price has not been mentioned by the question, so we are safe to assume that the new share will be issued at the prevailing market price if no information given. Here the information is available, so why not, we'll stick to that. So we say this will be 2 lakh rupees and one share will fetch me 20 rupees, so I get 10,000 shares. Here I want 1 lakh rupees, issue price set is 20, so we will issue 5,000 shares, whereas here 1 lakh again by 20, so we have 5,000 shares. And once you are having these number of shares, then the next thing that you need to check is the rate of tax. So tax rate is how much? Just check please. The applicable tax rate is 50%. Once my table of financing is ready, then I am just supposed to go through the required part of the sum and finish it off. So let's begin. The first says get the EPS. Now do we know how to calculate this EPS? We learned it in chapter of leverages. We are now learning it in the chapter of capital structure. EPS is just calculated by preparing an income statement. So straight away we'll go for the income statement. So my first point is income statement to get the EPS. Now let's understand the computing of EPS. So we have to calculate EPS plan wise, plan A, B and C. Plan A, plan B and plan C. So we'll start with EBIT. Could you please check, friends, in the question and tell me how much is the EBIT? So the EBIT here is 80,000. It is 80,000 here and it is 80,000 here. From the EBIT, we are now supposed to subtract the interest. Now, as the table is already there in front of me, you can notice in the table, it is only plan B where we have debt. If we have debt, so there will be no interest in these two plans. 1 lakh is the amount of debt at a rate of interest of 8%. That gives me 8,000 rupees as the interest obligation. Now when I subtract the interest, the resultant we all know by this time that it's going to be EBT, and that's going to be 80,000, 72,000 and 80,000. From this we now subtract the tax, and the applicable tax rate given, friends, is 50%. So that's going to be 40,000, 36,000 and 40,000. So when you subtract the tax, the resultant becomes EAT, and that's going to be 40,000, 36,000 and 40,000. Now if you notice, in one of the plan we do have preference shares as well. So preference shares being there, we will have to compute preference dividend as well. So we now subtract preference dividend, and DDT rate is not given, so we can ignore it. Preference dividend is there in which plan? It's there in plan 3. So there will be no preference dividend here, no preference dividend here, but dividend of rupees 8,000 here. And this becomes the earnings for whom? For the equity shareholders. So that's going to be 40,000, that's going to be 36,000 and 32,000. My objective, question says, is to calculate the EPS. So if I have to calculate the EPS, then I'll divide it with the number of equity shares, which will give me the earnings per share. I told you that table can be of immense help to us. So that is 10,000, we have 5,000, and we have 5,000, which gives me an EPS of 4 rupees. So this is going to be 7.2 and this is going to be 6.4. So these are the respective EPS for each plan, and answer to the first point is done. I told you, you just have to prepare the income statement, that's it. Second is financial break-even point, that is nothing but FBEP. So let us understand this FBEP. I'm doing the calculation here, friends, for FBEP. What is the formula for FBEP? How did we calculate FBEP? What happens at FBEP? At FBEP, we break even, that is EPS equals 0. Do you know the formula for FBEP? We have just discussed it in the previous sum. FBEP, you have to ensure that you earn minimum to the extent of interest plus preference dividend including DDT. By dividing this with 1 minus tax rate, what are we doing, friends? We are converting after tax preference dividend to before tax. There are 3 plans, plan A, B and C, and we have to calculate the EPS, the FBEP. So we have plan A, plan B and plan C. I'm again telling you, you don't have to go anywhere. This table can help us to get the entire answer. Look at the table. Do you have any interest here in plan A? Debt? No. Any preference dividend? No. So we can say this is 0 plus 0. So your answer here, FBP is 0. But if you notice in plan B, there is a debt of rupees 1 lakh, which is at the rate 8%, and that means there is interest obligation of rupees 8,000 plus 0, making an FBP of rupees 8,000. Plan C, if you notice, there is going to be no debt, but there is preference dividend of rupees 8,000 by 1 minus 0.5. So that's going to be 16,000 FBP. So that becomes the answer to the second point, that it's going to be 0, 8,000 and 16,000 for the respective plans. Now we have to calculate indifference level. When I was discussing indifference level, friends, I'm not going to do the calculation. I'm just going to explain you how it is calculated, because that I have done it in the previous sum. So objective is to discuss one fine point of this sum. Indifference level or indifference point between two plans is that special level of EBIT where we are indifferent. That is, at indifference level, EPS of plan 1 equals EPS of plan 2. But sir, here we have 3 plans. So how would you calculate indifference level amongst these 3 plans? Sir, what's the way out? The only way out is you have to calculate indifference level by selecting 2 plans at the same time. So I would say I will calculate indifference level between plan A, plan B. I will calculate indifference level between plan A, plan C, and then indifference level between plan B and plan C. So you can't combine all the 3 together. You have to do the calculation separately. So first we'll calculate indifference level between plan A, plan B, plan A, plan C, plan B, plan C. Did you get this? So we prepare that equation at indifference level, EPS of plan 1 equals EPS of plan 2. EBIT minus interest into 1 minus tax rate minus preference dividend by number of equity share of plan A equals the same formula, but denominator will be EBIT, number of equity shares of plan B. So that thing will continue for all the three plans. But when you will solve this sum and when you will calculate indifference level between plan B and plan C, you would realize that on solving that part of the sum, the EBIT in that equation will get cancelled. I will do that calculation so that you get a clear idea what I'm telling you. So we are going to calculate indifference level between plan B and plan C. That is the only point, friends, that is worth noting here, because rest in all the plans you will be able to get the indifference level by doing the computation. So at indifference level, so we'll first calculate between plan B and plan C. At indifference level, what happens? At indifference level, EPS of plan B would become equal to EPS of plan C. So when I solve this, if I use that formula, I would say EBIT. I can refer my data of the table. The table shows in plan B we have interest of rupees 8,000 into 1 minus 0.5 minus 0. The whole is to be divided by the number of equity shares of 5,000 equals EBIT minus 0 into 1 minus 0.5, because in plan C we don't have any debt, but in plan C we have preference dividend. So we subtract that 8,000 and we divide it with the number of equity shares of plan C, which is 5,000. I'm telling you again, you will get the entire solution information from your table done. So 5,000 ones are 5,000 ones are, so we now have 0.5 EBIT minus 4,000 equals 0.5 EBIT minus 8,000. Now when you solve it, this EBIT itself is getting cancelled. Now when EBIT is getting cancelled, this signifies that there is no indifference level between the two plans. There is no indifference level. So we can write the conclusion like this: there is no indifference level between two plans. Did you get this? Okay. Now what does this mean? If you remember, just before we started with this sum, I told you that on a graph there are two plans. It is indifference is that point, indifference level is that point where we get the same EPS. Speciality of this point is what, friends, at this point one plan dominates the other plan, but once that level is crossed, reverse happens. The other plan now, which was less dominated, will start dominating the original plan. But when these two lines, when EBIT is getting cancelled, it means these are going to be just two parallel lines which will never intersect. That itself means that there is no indifference level. Now, why both are not going to intersect? Between the two plans, given a choice, that is, I'm talking about only B and C here, you will get indifference between A and B, you will get indifference between A and C, but B and C, there is going to be no indifference level. Between the two plans, given a choice to you, which plan would you prefer to raise money with? Would you select money, raising of money by way of plan B, or would you try to raise funds by way of plan C? This is what is the point of discussion. Between the two plans, which plan is going to be always better than the other? Friends, if you notice, everything is the same. See, we require 2 lakh in both the cases. Our number of equity shares are the same. The tax rate is same. The rate of interest, the rate of preference dividend is the same. Everything about these two plans is the same, yet one plan will always be better over the other. Which plan? In this case, it will be plan B. So why so? You can have a look at the income statement that can give us a clear idea. See, if you notice, EBIT is also the same. Still, EBIT is the same. Everything in the table is the same. Still, EPS of plan B is higher as compared to that of plan C. Why is it happening? If you notice, in plan B, we have an outflow of rupees 8,000. Yes, sir. So that outflow of 8,000 is also there here as well. Income remaining the same, commitment is 8,000 in both the plans. But because of this 8,000, what is happening? Because of this 8,000, we are able to save another outflow. This 8,000 and this 8,000 both are fixed commitment. But this 8,000 is helping me to save another outflow. And what is that other outflow? That another outflow is of tax. This 8,000, which is nothing but the interest, is helping me to reduce my taxable income. Thereby, it is helping me to reduce my tax liability. We are saving tax of rupees 4,000 because of what? This 4,000 which is getting saved is only and only because of this one factor called interest here. If this interest was not there, my taxable income would have been 80,000 rupees. I would have paid tax of 40,000. But can I say because of this interest, I am paying only 36,000. So I am saving 4,000. So where is that 4,000 which is getting saved going? It is actually increasing the profits of my equity shareholders. Exactly by 4,000. That 4,000 of tax you can't save under plan C. Why? Because this preference dividend of rupees 8,000 is not allowed as an expense. It is an appropriation of profit, friends. And since it is an appropriation of profits, you can't save your tax. But interest of 8,000 is saving tax of how much? How much we are saving? 4,000 rupees. How did we get to know that 4,000? You simply take it this way. If I ignore interest, then my taxable income would be 80,000. On that 50% will be 40,000. But if I consider tax, then I'm paying only 36,000. So I'm saving 4,000. I can calculate this 4,000 in an alternate manner as well. One more way to calculate tax savings due to interest. Remember, I will require it in cost of capital as well. One more way to save tax is you take that interest itself, the amount of interest itself, just multiply it with tax rate, you will come to know how much we are saving. So we are saving how much? 4,000. How can I get that answer? Take that interest of 8,000, just multiply it with tax rate, we'll get the answer. So whenever we have to calculate savings of tax due to some expenses, you take that concerned expense, just hit it with tax rate, you will get the amount of tax savings. That tax which is getting saved here is increasing the profits for the equity shareholders, and hence, friends, you will realize under any circumstance, in this case when everything is the same, plan B will always dominate plan C. Only because of this reason, tax savings due to interest. The last line which they say, compute the EBIT range and indicate if any plan dominates the other. Yes, it is plan B which is dominating plan C, and it will always dominate under any circumstance, only due to one reason, savings of tax. In this sum, it is we are saving tax of 4,000, which can be calculated as interest into tax rate. Is that okay? Fine. So when you have to write down the solution for the last point, you could have written like this: plan B dominates plan C. This is because predominantly other things remaining the same, that is rate of interest, rate of dividend, number of equity shares, the EBIT, everything keeping the same, interest is allowed as an expense, which helps us to reduce our taxable income, thereby reducing our tax liability. There will always be savings of tax due to presence of this interest. And how do we compute the tax savings? Interest into tax rate. That savings won't occur in plan C because preference dividend is not allowed as an expense. It is rather an appropriation of profits, and hence we will always give priority or dominance in this sum to plan B over plan C. Is it okay? Fine. So this was entire discussion of question number 3 which we have done. One sum remains for discussion, and that's going to be question number 2, which I would personally suggest that you please do refer it during your exam time. This had come in the previous papers as well. An interesting one. Chances of making mistakes there are quite high, so that's the reason I've kept in our discussion purpose. So we'll take up question number 3 now. Okay, so let's take up the next sum, question number 2, which is an interesting one. So let's read it. Question number 2. Shaji Steels Limited requires rupees 25 lakh for a new plant. This plant is expected to yield EBIT of rupees 5 lakh. While deciding about the financial plan, the company considers the objective to maximize the EPS. So you can underline that statement. So the object of the company is to maximize the EPS. It has 3 alternatives to finance this project. The first one is by raising debt of rupees 2.5 lakh or rupees 10 lakh or 15 lakh, and balance in each case by issuing equity shares. The company's share is currently selling at 150. Friends, how would you interpret the word selling at 150? The word currently selling at 150 indicates it's the prevailing market price of the share, but it is expected to decline to rupees 125 in case the funds are borrowed in excess of rupees 10 lakh. These funds can be borrowed at the rate of 10% up to 2.5 lakh, at 15% over 2.5 lakh and up to rupees 10 lakh, and at 20% over 10 lakh. The applicable tax rate to the company is 50%. Which form of financing should the company choose? So it is we who have to decide which form of financing the company should go for. And the answer we all know, the objective is to maximize what? EPS. So we would go with that option which would maximize our EPS. So how do we get that? The EPS is to be calculated just by preparing an income statement. But I again tell you, so if you have to calculate EPS and decide which plan is the best, the basic stuff is prepare the financing plan detail table. It will be of great help. Now, usually when I tell students to solve this sum on their own, they goof up, they do a lot of mistake in that table itself. Because if the table goes wrong, your entire solution goes wrong. So you need to pay attention to the financing plan detail table. So let's understand this, how the table would be prepared. So we have financing plan details. Friends, if you can just check for me and tell me how much is the amount of funds that is required. So if you notice, you will realize that the funds required are for purchasing that plant, and if I'm not mistaken, we will require 25 lakh rupees. The plant is worth 25 lakh rupees. Now, how many options do you have to arrange that 25 lakh? You realize that you have 3 plans for that. So we have plan 1, we have plan 2 and plan 3. But whether you select the first plan or whether you go for second or you go for the third plan, you are going to just raise 25 lakh rupees. Okay. Now, in the first plan, what they say, if you read, the question says, it has 3 alternatives to finance this project: by raising debt of 2.5 lakh or 10 lakh or 15 lakh, and the balance in each case by issuing equity shares. So what we'll do is we'll not first focus on what is the debt requirement, we'll go for the equity part. So I can raise the balance part by way of issuing equity shares. So we have equity share capital. You can raise debt of up to 2.5 lakh. So if you take debt of 2.5 lakh, 22 lakh 50,000 will be the equity. In the next case, you can borrow 10 lakh rupees. It means 15 lakh will be raised by way of equity, and here you can borrow 15 lakh, so 10 lakh is what you will issue equity. Now what people do is when they solve the sum, they do it like this. So we will take 2 lakh 50,000 here, we will take 10 lakh here, and we will take 15 lakh here. This is what mistake these people commit. But that will be wrong, because the loan is not available at a flat rate of interest. It is available at slab rates. So you need to be careful. So loan is available at slab rates. So how we would prepare this table now? If you notice, question says the loan is available at 10% rate of interest, correct? So it's available at 10% rate of interest up to 2.5 lakh. So if you go for this loan up to 2.5 lakh, you will be charged 10%. So now here your requirement is only 2.5 lakh, so you'll raise it entire by way of 10%. In the second case, you need 10 lakh. So up to 2.5 lakh, you will still be charged 10%. Over 2 lakh 50,000, but up to 10 lakh, that means the next slab is of 7.5 lakh. So for 7.5 lakh, you will be charged interest at what rate? If you check, you will be charged interest at 15%. In the third case, you will be again taking a loan of 15 lakh, but for the first 2.5 lakh rupees, you will be charged interest at 10%. Over 2 lakh 50 up to 10 lakh, that is the next 7.5 lakh, you will be charged interest at 15%, and over 10 lakh, that is for the remaining amount, whatever loan you want, you will be charged interest at 20%. So we require another 5 lakh rupees, so we'll be charged interest at 20% for that 5 lakh. This is the pattern of arranging money. So you need to be careful. These are slab rates. These are not flat rates. Okay. Once you have done this requirement of funds, then the next point is to calculate the number of equity shares. I told you, sometimes the question will give you the number of equity shares. Sometimes it will not be given. So if it is not given, so we'll have to calculate it. How do you calculate that? That is equity share capital, and you just divide it with issue price. Equity share capital, it is to be just divided by the issue price. Now, how much equity I want here? 22 lakh 50,000 rupees is what I desire. But sir, in this sum, unlike the last sum where issue price was given, here we don't have the issue price. So sir, what should we do? Should we assume that the face value is 10 and issue is at par? You can do it if no information would have been given by the question regarding the prevailing market price of the shares. If you notice, this company already has some shares that are trading, and its prevailing market price is going to be rupees 150. So if you already know your share is worth 150, then what's the point of issuing a share of 10 at 10? It would be more appropriate to issue one share, the new share, not at 10 but at its prevailing price, which is going to be 150. So here my issue price is going to be 150 rupees. Did you get this? Because I know the worth of my share, the value of my share itself is 150, so I'll issue it at 150. Similarly, here I require 15 lakh of equity. I'll issue the share at 150. In the third case, it is 10 lakh. But I'll not issue at 150 because I am of the opinion that if I borrow funds in excess of 10 lakh, see what is they have written. The company's share is currently selling at 150 but is expected to decline to 125 in case the funds are borrowed in excess of rupees 10 lakh. So if you exceed 10 lakh, then the market price of a share will fall. Why it will fall, that we will discuss. But here the price of the share will become 125. So if I now calculate the number of shares, I think that's going to give you 15,000 shares here. This is going to give you 10,000 shares. And if I'm not mistaken, this gives you 8,000 shares. You please do cross check whether these values that I've written are correct or not. Now once you have these number of equity shares, then the last point here is to take the tax rate. What's the applicable tax rate? The tax rate applicable is 50%. So we can consider this 15%, 50%, and now I can conclude my entire table, financing plan detail table is ready. It is we who have to now select which plan among the three is the best, and to determine that, since the objective of the company itself is to maximize the EPS, we can do that calculation of EPS and take a call accordingly. Again, it boils down to the same thing, get the EPS. EPS, we get it from income statement. So what we'll do is we'll just prepare the income statement and our job is done. So we'll now go ahead with this income statement. So the income statement which we are going to prepare, again I would like to ask the same question. Is it going to be an actual income statement or is it going to be an estimated one? Obviously estimated one. So let's prepare the income statement now to select the appropriate plan. So we have estimated income statement. There are three plans under consideration. So we have plan 1, plan 2 and plan 3. So we can begin with now again the EBIT. If I'm not mistaken, and you are allowed to use these short forms of EBIT, EBT and all that stuff in the exam. So don't bother with writing the entire stuff, earnings before interest and tax. EBIT is allowed. So we now have EBIT of rupees 5 lakh. So once I have EBIT of rupees 5 lakh, from the EBIT, I would now deduct the interest. Now, chartereds, look at the table. Look at the table. Take your time and see how we are going to calculate the interest. In the first plan, I'm having a debt of 2.5 lakh rupees. The rate of interest charged is 10%. It means my interest amount here is 25,000. Can I say that same loan will come in plan 2 and plan 3 as well? So that loan is going to bring an interest obligation of 25,000. It is 7,50,000 of fresh loan which we are going to take in plan 2. So I take 7,50,000 at 15%. Will this commitment occur in this plan? No. Then 7,50,000 into 15%, I have to pay 1,12,500 here, and that will come here as well. There is going to be an additional loan of rupees 5 lakh only in the third plan. So we now have 5 lakh. But the rate of interest is not 15%. Here it is 20%. So we can say we will have to pay interest of rupees 1 lakh. Now when you subtract all these commitments, that is interest, from the EBIT, what we get now is EBT. So we have the EBT, that is earnings before tax. So let's calculate. If I'm not wrong, this is 4,75,000. This becomes 3,62,500. 262,500. Please check the figures that I'm writing. Once you get this EBT, then from the EBT we are now supposed to deduct the tax, and the applicable tax rate is 50%. Now if you wish, you can even avoid your tax calculation, because if tax is 50% of EBT, your EAT, that is profit after tax, also has to be 50%. So EAT will also be 50%. Look at the table again to see whether there is any preference capital. No. So we don't have any preference capital. So this itself is earnings for whom? Bolo yaar, earnings for equity shareholders. And once you have this earnings for the equity shareholders, then we are supposed to divide it with the number of equity shares which would give us the earnings per share. So let's do that. So I want 50% of these values, 475. So that's going to be 2,37,500. 362, 500. I think that's going to be 181, 250. Yes. And this is going to be 131, 250. Now number of equity shares are also available. They are going to be 15,000 here. They're going to be 10,000 here. And we have 8,000. So when you divide this one, I think we can directly do it. 18.125 here. 131, 250 divided by 8,000 gives me an EPS of 16.41 rupees. 237,500 divided by 15,000, that gives me an EPS of 15.83. So if you are a rational human being and if the company is asking for you guys to advise, which plan would you recommend? The plan that maximizes our EPS. And guys, the plan that is maximizing the EPS is plan 2. So company is advised to select plan 2, and any which ways the objective of the company itself is to maximize what? The EPS. Because if you note down, it's clearly mentioned, I told you to underline that its objective is to maximize the EPS. Since the objective of the company is to maximize the EPS, company is advised to select plan 2. I hope you found the solution to this question manageable, and I'm again telling you, the savior for us in this chapter is this table. If your table goes correct, then you don't even have to bother about looking at the question again and again. You can just finish it off. The point that I want to explain here is why the market price of the share is going to fall. What's the reason for this? That point, and then with this we can conclude that the chapter of capital structure is also taken care. Now, what is now happening here? At present, the market price of the share is 150 rupees. Now what happens when there is going to be more amount of debt? As the level of debt in the capital structure increases, risk increases. Do you agree? So now, do you think all equity shareholders would be willing to take same level of risk? No, not at all. There will be some class of equity shareholders who will think, यार अब बहुत ज़्यादा risk हो गया यार, बहुत fixed commitment आ गया, huge risk. Now since there's a huge risk, we don't want to take that risk, and they'll start selling their shares. The moment people start selling their shares, it will create selling pressure, supply will be more, demand will be less, the price will come down, and it is expected that in this sum it will stabilize at around 125 rupees. So the reason for the fall in the market price can be attributable to a huge debt in this plan. I hope you followed this part of the discussion, and we have been able to cover up all the crux part of this chapter, which basically includes selecting a plan, indifference level, and the financial break-even point. That was the only thing that was supposed to be learned in this chapter of capital structure.